Well, welcome everybody. Thank you for joining us. We've got a great little attendance this afternoon. It's great to be able to communicate with our client community in so many methods these days. My name's Paul Shepherd. I'm a senior advisor and partner at Alman Partners, and today Niyati is joining me.
Yes, hi Paul, and hello everyone. My name's Niyati, and I'm an associate advisor with Alman Partners. It is lovely to be able to connect, particularly during this time, using this technology platform with all of you. And certainly very uncertain times. And I hope that health-wise you're all keeping safe and staying healthy. Outside of the health risk, we certainly want to acknowledge how tough it is out there for our business clients, and particularly also some clients who've lost jobs in this time. Please remember, we are here. Feel free to contact us, reach out to us if you need any assistance in accessing the support that the government is providing.
Yeah, definitely. It's definitely tough times for everyone and interesting times. But today's webinar is, well, the purpose of the webinars is to keep you informed of what's going on with Alman Partners, and that we're still business as usual, other than not being able to physically have meetings in office. Secondly, it's to revisit one of the fundamentals that underpin a successful investment experience, and that's not making your financial decisions based on short-term market volatility or financial conditions. And lastly, to be a bit of a voice of reason and provide some perspective amongst all of the media and noise that's getting thrown at you on a day-to-day basis. It's exhausting if you have too much, if you tuned into the media too much. So be here to know that you're in good hands and help you sleep at night.
Absolutely, Paul. I think while technology is being used for all that media noise out there, I think we are leveraging technology to send out a very positive message out there, and hopefully demystifying and helping you with any concerns or questions you have. This particular webinar, the topic is the importance of staying seated, and it is the fourth session that we are holding in this week. And particularly just a few housekeeping things. All participants other than Paul and I, of course, are on mute, but we certainly encourage you to ask any questions, which you can do by clicking on the Q&A icon that you can see on your screens. This webinar is certainly being recorded and will be available to you should you wish to look at it later on. Paul and I, we're going to be targeting 10 minutes, 15 tops, Paul,
We'll do our best.
Absolutely. And like I said, any questions, we'll certainly take it. We'll try and address those at the end. And I suppose, Paul, to get started, the first question that we probably want to address, and clients might be thinking, would be, how is Alman Partners affected by all this, and what does it mean for our clients?
Well, about 18 months ago, we were fortunate enough for Matt Feltham to join our team. Matt brings a wealth of technology expertise and experience to our firm, and in the short period of 18 months has set us up for the move to the new offices, and to be able to transition to a work from home operation, which we currently are. Most of our team are working from home as we speak. There's just a couple of us left here in this big beautiful office of ours. But from a client's perspective, it's business as usual. The only difference is that we aren't able to host you in our offices and provide you with beautiful coffees. And we will, obviously revert to our office opening at some point in the near future when things return to some sort of norm. In terms of contact, if there's any friends, family or colleagues of yours that you believe we can add value to in this time of turmoil, please put them in touch with us or let us know and we can reach out to them. We've got email, phone. We're doing webinars as per this correspondence, and we're holding meetings via Zoom, which are one-on-one meetings, and as personal as you can get, I think, in the current circumstances. So for us, business as usual. It's just that we can't host you in our new offices.
Absolutely. So we're certainly leveraging technology, and as Paul said, it's business as usual. Now, before we get into the topic for today, a disclaimer a disclaimer to be put out there. Please understand the information presented and discussed today is general in nature. Before making any investment decisions, please contact us. If you're certainly watching or listening to this webinar and you do not have a financial advisor, please feel free to reach out to us.
Excellent. Well, on that note, let's get started. We'll start with a sketch from Carl Richards. Carl Richards is from The Behaviour Gap, and he's created some fantastic sketches over time, but none as timeless as this one, I don't think, Niyati.
Certainly, Paul, and particularly relevant in the current times. And we don't have to go too far back in history to recognize us as human beings acting out of emotions. Just going back to 2009 is a classic example. GFC saw a whole exodus of funds out of the market, people selling down. That was an emotion of fear driving that action, and people sort of stepped back, holding on to wait to get back into the market. The market did rebound, but the big question really is, when do we know that it is bottomed out, and when do we know we are ready to come back in? We all know for a successful investment experience, we should be buying things when they're cheap and selling when they're high. But it's particularly difficult to do that because as human beings, we do have emotions that come into play, particularly when it concerns our own money. And this cycle is certainly a sure way to lose money.
Precisely. We're not robots, are we? So, we are all affected by the news that gets thrown at us, and it certainly affects the way we feel about things and how we react. So I guess our job, Niyati, is to help our clients through this, to be the coach, to be the voice, to bring back to reason and back to the plan, and focus on the things that are in our control. When I look at these, this chart, very similar to the previous slide, but we look at the right hand side of this chart, and you think about the journey from 2002 to 2007, and how positive the markets were in that period, and how people became overconfident in the view that they didn't think things were going to change. It was going to continue to be like that forever. But I suppose that there's ups and downs with every market. The markets will never change. There'll always be some event, and there's always a different slant to every event. But the markets adjust and return. So in the period of expansion, everyone was overly confident and jumping on board. And as you see down the bottom left-hand corner, it's the herd mentality. Everyone gets confidence from each other. But the reality is when things turn around, as we experienced in the GFC on the left-hand side, where there's a lot of regret and selling, as you mentioned just a second ago. So I think this comes back to the importance of being able to focus on the things that are in your control and things that are important to our clients and goals.
Absolutely, Paul. I would think that the message clearly is to stay invested, but it's particularly hard in these times when it feels like the markets haven't experienced something like this before.
That's right, and this chart here I refer to a lot, and I call it the heart. This is like a heart rate monitor. When the markets are falling, your heart rate goes down and comes up and down, But this is a really relative chart for us because it starts at 1989, and I think all my partners, Scott started off in 1985. So some of our clients have experienced this whole journey, and if you could draw a straight line from the start point to the end point, knowing that there's somewhere in the middle of that diversified mix of outcomes there, and if you draw a straight line, it's a great outcome. And but there's a lot of bumps along the way. So a lot of our clients don't have 100% exposure to the share market, but the longer term you give the volatility right out, it's the history keeps repeating itself, as this next slide shows.
Absolutely, Paul, and this is a great pictorial representation of about 119 years of history of the Australian stock market. And there's certainly outlier events like the 2008 GFC, which had a minus 43% return in that particular year. But I must highlight that those are the years where we as advisors, Paul, really add value to our clients. So just referring to this report that Vanguard had released around what sort of value do financial advisors add, and they've found that over the lifetime of a relationship with a financial advisor, you're talking about 4 to 5%. And part of that really is for us to address our clients' concerns, and particularly in uncertain and highly volatile markets as they are currently, keep them seated, keep them disciplined. And again, looking back at this chart, 81%, that is 96 positive years over the 119-year history. Certainly some great years in the 80s, but those are more outliers again, Paul. But looking at the overall 119 years, the average return's been about 13.5% for the Australian market as a whole.
Yeah, statistically, whether you're looking at, I know the initial reaction is, well, we're not invested for 119 years, but statistically, that curve of outcomes and is pretty powerful and pretty narrow. So it's good, very good data to look back on and zoom out. And here's another way of zooming out, I guess, is looking at it from a decade perspective, not an individual year perspective. And you can look at each of these figures over decades, and they're all extremely positive. But probably the one decade that I reflect on and wonder, how you would ever stayed seated emotionally without having some support or someone to turn to keep your objective is through 1910 to 1920. In that period, as you know, experienced World War One, and the Spanish flu was in there, and to try and stay seated and not be emotional in that period, I can't imagine. But it's our job. Our job is to make sure that we try to step back, not get too caught up in the time, and build a plan that's relevant for our clients' situation and their goals, and focus on the things that are important. Is there any decade in there that stands out to you, Niyati, or is personal for you?
Definitely, Paul. I think the GFC, the 2008, with its negative 43% returns, if we travel back in time, sitting in 2008, the feeling of anxiety and the feeling that probably there's no end to that negative returns. But look, 2009 had a return of 39.6%, and that decade with such significant negative returns still ended up with an average annual return of 11.1% over that 10-year period.
Yeah, it's amazing how resilient we are, and how markets can continue to adapt. So we've looked at the positives and the benefits of staying seated and zooming out, but this is an amazing slide that talks a bit about the consequence of trying to time markets, and how dangerous it is, Niyati.
Oh, absolutely, Paul. The consequence of trying to time market, well, I would say firstly, it's a hard game to play, and it's certainly a game that can hurt your returns tremendously. So, the slide talks about $1,000, but let's add a few more zeros to it and consider $1 million portfolio right at the beginning of this 19-year period that we are looking at. So in 2001. If you, like most of our clients, would have remained invested during that period of time with all its ups and downs, the portfolio would be worth $4.6 million today. Okay, but let's say you missed 25 of the best daily performances during that 20-year period. Your value, the portfolio would be valued at $1.6 million today. The reality is you'd be best off keeping that money in the bank and not riding and taking on the volatility associated with investing in the markets. Mind you, I'm keeping inflation on the side at the moment. The question, Paul, really is, how do you know which one of those days is going to be the best performing day for the market?
That's exactly right. And I think recently more than ever, and that you've found this data in your travels, Niyati, that in amongst all of the turmoil from this COVID-19 and all of the fear and reporting that's going on in late March, I think was one of the best trading days that the US market has had. I think you remember the date and the numbers, don't you?
I think that date is going to be in my memory for a very long time yet. So 24th of March, in the middle of all the panic and the uncertainty and volatility in the markets, the US stock market returned the best ever return, single day return in 83 years since 1933. And that's the fifth best day for the market in its history. And well, I wonder who saw that coming. I certainly didn't.
It certainly doesn't feel like it's an environment for a best day of trading, that's for sure. Okay, well, I guess we'll finish off the material today, and I don't know, I think we've gone reasonably well for time. A bit over time, but look, well, Niyati, if you can dig up any questions that have come through, I'll just recap on what we intended to cover today. And that was to keep you informed where Alman Partners is at, and that where trading is business as usual, other than the fact that we can't host you in offices. We spent a bit of time revisiting on one of the fundamentals of what underpins a successful investment experience, and that is, focusing on what's in your control and not and staying seated and not responding to any short-term market volatility or external changes or events. And finally, to know that you're in good hands, know that we're here, and that your plans and keeping focused on the things in your control, so that you can have a good sleep at night and not worry about your finances. How do we go for questions?
So I can't see any questions that have come through, but look, if by any chance you haven't managed to get your questions into us, please feel free to give us a ring or just write in, and we'll contact you.
Absolutely. So, well, that brings the webinar to a close. Look, we're learning and trying to improve the way we communicate. So if all of the attendees today can hang around for an extra few minutes after the webinar, you'll be going through to a bit of a survey, SurveyMonkey survey. We would love your feedback. We'd love to know if there's things that we can do differently to help you. But yeah, please hang around and fill that information out. Valuable learnings for us.
Yeah, we certainly look forward to your feedback. As I mentioned earlier, we're trying to make sure that we are available and touching base with our clients. And we will continue this sort of webinar webcast out for you. The session for next week would be the importance of diversification, where we really start looking at how we engineer our portfolios for our clients. So just keep an eye out for the details for that particular session to come through to you as well. And thank you for joining us today. Stay safe. Please look after yourselves. Focus on things that are important to you, and we'll get through this together. And thanks once again, everyone.
Thanks, everyone. Take care.